Good morning, America. Today I want to begin my series on the Great Depression. First of all, I'm going to talk about the stock market and particularly the stock market crash of 1929. The stock market crash of 1929 is important because it was the trigger event for the Great Depression. Remember, when we talk about complicated historical events, there are trigger causes and long-term causes. So the stock market crash was the trigger cause of the Great Depression. It's the event that actually marks the start of the Great Depression. There were other causes of the Great Depression, but the stock market crash was what actually started it. So let's get going. Alright, so the first thing to say about the stock market is that investing in stocks was extremely popular in America in the 1920s. For those of you who haven't had personal finance with me or are not sure, buying and selling stock, when you buy and sell stock, you are buying and selling pieces of a company. I start a company, I slice the company up into 10 pieces like a pie. I call each of those pieces a share. I sell those shares. I use that money to then finance the operations of the company. People who own those shares can then buy and sell them amongst each other on a secondary market, and that's what the stock market is. Alright, so buying and selling stocks was something that ordinary people started doing quite a bit of in the 1920s. The 1920s is when this really becomes accessible to ordinary people for the first time. You have brokerages that open up all over America, and ordinary people can open up a brokerage account and go to their local broker or call their local broker and tell them, what they want to buy and what they want to sell and so forth. Now, that's not to say that everybody was invested in the stock market. Obviously, you have to have money to invest with. So this tends to be something that people on the wealthier and more well-into the economic spectrum tend to do. But nevertheless, this is not just limited to some pool of ultra-wealthy, though of course the ultra-wealthy were heavily invested in the stock market. But even ordinary people have money invested as well. Throughout the 1920s, the main thing to say about the stock market is that the prices are going up and up and up, which is not too surprising because all these new investors are coming into the market and buying, and that drives the prices up. The other thing to say about the stock market of the 1920s is that basically the whole thing is a house of cards. And it was a house of cards for a couple of reasons. The first reason the whole thing is a house of cards is because a lot of the companies weren't actually very stable. Some of the companies that were being bought and sold didn't actually represent actual companies. For example, in the 1920s, it was common for people to buy shares of a particular type of company called a stock trust. A stock trust at that time was a company whose sole purpose was to own shares of other companies. So, for example, I'm going to start the X-Line Stock Trust. The X-Line Stock Trust is not an actual company. It has no assets. It produces no goods, nor does it provide any services. The only thing the X-Line Stock Trust does is buy and own shares of other companies. So the X-Line Stock Trust buys 100 shares of Coca-Cola and 50 shares of DuPont and 25 shares of Goodyear. Then I take X-Line Trust, and X-Line Trust issues shares. So then maybe you buy shares of X-Line Trust, but you're not actually buying an actual company. All you're buying is essentially shares of other companies at one step removed. It's not a firm foundation. It's all very unstable. The other thing that makes it a house of cards is that the whole thing is built on debt. Lots of it. Now, a lot of people, the 1920s was a very a prosperous time in America, so there's lots of money sloshing around in the system, and a lot of people do have money to buy stock with. But just because you don't have money doesn't mean that you can't buy stock in the 1920s. People oftentimes buy stock with borrowed money. When you buy stock with borrowed money, it's called margin. And so a lot of people were buying shares on margin in the 1920s. So I want to buy a share of Coca-Cola. I don't have to have the money for that. My broker will be happy to lend me the money for that. So let's say my broker, I want to buy a share of Coca-Cola for $5. I don't have it. The broker lends it to me. And so the broker lends me $5 and I buy the share of Coca-Cola with it. Of course, I'm going to have to pay the broker interest. But that's okay as long as the price of Coke goes up. I can pay the broker interest and still come out ahead. The problem, though, is when the values eventually go down. But in the late 1920s, people acted as if the prices were never going to go down. People seemed to literally think that the prices were always, only, ever going to go up. Yeah. Well, in the physical world, we have the law of gravity, and the law of gravity applies in the financial world as well. Sooner or later, what goes up must come back down again. And the bubble popped in October 1929. By that point, the prices had gotten so ridiculous, they were out of all proportion to reality. The market was way overdue for a correction, and that's exactly what happened. And so the prices eventually started to go down. Now, the prices started to go down in September, but the selling really picked up speed in October. By October 19th, 1929, the prices had gone down enough that brokers were starting to issue margin calls. What that means is all those people that they loaned money to buy shares with, they're saying, "Hey Joe, I can't lend you $5 anymore because the price to buy Coke with because Coke has gone down too much. You gotta pay me back that $5 like right now." And Joe doesn't have the $5. He's going to have to sell Coke, his share of Coke, to get the $5 to pay them the broker. But what if Coke has already gone down too much? Maybe Coke isn't worth $5 anymore. Maybe Coke is only worth $4 now. And so that's not even going to cover the margin call. And so investors start having to sell to meet the margin calls. And the selling pushes the prices down further, which creates yet more margin calls, which creates yet more selling, and it becomes a vicious cycle. And so the market just goes down and down and down. On October 24th, the market plunges so steeply that they call it Black Thursday. And they thought they had seen the worst of it. But they hadn't, because the next week, October 29th, was even worse. They called that Black Tuesday. Black Tuesday was worse than Black Thursday. Black Tuesday was certainly up to that point, and for many, 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 many years later, was the worst one-day period on the stock market of all time. It's probably been matched since then, but not very often. And by the time by the end of October, by the time the selling is done, a significant number of people have been completely wiped out financially. Everything they have is gone. There are stories of brokers in New York committing suicide because they've lost everything. But it's not just the ultra wealthy who have lost big. Ordinary Americans across the country have lost their life savings as well. The stock market even after the big sell-off in October 29, the stock market continues to go down. The stock market didn't actually bottom out until the early 1930s, so for several years the stock market basically did nothing but go down, erasing a substantial portion of all the gains of the 1920s and wiping out lots of people financially in the bargain. Now, the stock market crash in and of itself did not cause the Great Depression because not everybody was invested in the stock market, but people who were invested in the stock market lost big, and it wasn't the sum total of the Great Depression, but it definitely set events in motion. Poor people didn't have money in the stock market; they weren't affected right away. There's a song there's an old country song that I kind of like that I think summarizes this concept well. The line goes, well, somebody told us Wall Street fell, but we were so poor that we couldn't tell. People who don't have a lot of money and who don't have money invested in the stock market crash doesn't affect them directly and not right away. But it will affect them in the coming years as the depression gets worse. All right, next time I'm going to continue to talk about the depression. I'm going to talk about how the depression spread out of the stock market into the rest of the economy. See you next time.